Hello, I'm Dan Ridsdale, Head of Technology at Edison. Today, I'm joined by Martin Davis, Chief Executive Officer of Molten Ventures, Europe's largest listed investment company focused on the technology sector. Martin, many thanks for joining me again today.
My pleasure, Dan.
And I think it's probably the big event over the last few months is the acquisition of Forward Partners. You've completed that now. Can you discuss that and particularly the main benefits that you think that will bring to shareholders?
Yes, of course, and obviously, I guess I'll focus on the benefits that I think it'll bring to Molten Ventures, which are, of course, completely aligned with the interests of shareholders. So, for us as a business, I think there are probably two principal advantages. One obvious one is that we've acquired a portfolio of really exciting assets, and those assets are a mix of some very early stage, really post-seed assets, right the way up through to Series A assets. And it's those larger Series A assets that probably give us the greatest opportunity to do follow-ons, traditionally where we would invest at that sort of growth stage. So we've fundamentally acquired a really good set of assets at what we believe is a really good price. I think the second thing that it brings us, and this is a little bit about the stage, is it brings us that capability to invest that builds out our platform. What we're trying to do is to build a platform, a multi-stage platform that invests in venture across the whole of Europe. And we have our seed fund of funds, which is obviously a really important part of deal flow. And we have our normal venture growth investing area. But it's this area in between the seed funds and where we would invest that Forward Partners has traditionally invested. And so we've just got that portfolio, but also we've got the capability. So we've brought in some investors who really understand how to invest post-seed, pre-growth. And it's a different risk metrics, and the risks are different, and it's a different investment philosophy. So it's really helping to build out that end-to-end multi-stage platform for us.
Very interesting. So really rounding out that continuum of your investment profile. And now turning towards your latest trading statement. Obviously, it's been a difficult 2 years for VC, but you've highlighted that you expect to see a step up in realizations versus the previous 2 years. And with several potential exit processes ongoing, can you please just shed some light on the current exit environment across VC markets?
Yes, of course. Look, I mean, I think everybody knows that with the macro factors around interest rates and cost of living, etc., has meant that the M&A market, the IPO market, has essentially been closed for the last couple of years. And so we are, of course, subject to those forces in the VC sector like everybody else. However, those factors do seem to be stabilizing, certainly the view on interest rates. And there is an overall view that as we go through this calendar year, that M&A market will start to ease up, and that we may be able to look forward to an IPO market returning potentially next year. So that has an impact across the whole of the VC sector. Now, what we've been doing as a company and as a business over the last couple of years is we've been building an exits profile within the business, and we've been working really hard at identifying the right time for business to exit, the right type of buyers for those at the right price. And we've really been working at that for the last 2 years. And with the macro environment starting to ease, we are starting to see that flowing through. We've given some guidance that through this financial year through to March 2025, we would expect to do approximately 100 million of exits. When you consider that last year in our results trading statement we've just announced last year, we did 39 million. So that would imply a significant uptick. We've announced just this week about Endomag, the exit for Endomag, and indeed it was announced in the media a few weeks ago, the exit of Perkbox. So those are two examples of businesses that between them will deliver us nearly half of that 100 million. And it's really, I think, demonstrates not that things have changed dramatically all of a sudden now, but that the hard work we've been involved in over the last couple of years in a better macro environment is starting to bear fruit. And I think we'll see more of that as we go through the rest of this financial year.
That's helpful. And then looking at maybe the portfolio companies who aren't nearing that exit phase, in the context of this tighter fiscal environment, can you talk through the cash runway across your holdings, and especially in your core portfolio?
Yeah, of course. And I think really the two really key bits of work we've been working on over the last couple of years is, one of them, as I said, our exit tracker, but the other is helping our portfolio companies during this downturn to extend their runways and to manage their cash. And we've been, again, really working on this for the last couple of years, and the situation improves each time we bring out a set of results. So we announced in our trading report last week that of the core, and the core accounts for about 65% of our NAV. So those 17 odd companies are the vast majority of our NAV. That across the core, they have 90% have runway of over 12 months, and 50% has a runway over 24 months. Now, you might think that 90%, 50% over 12 to 24 is quite a drop off, but not really, because that's what we would expect to see. We don't want these companies to be hoarding cash. We want them to have the right amount of cash so that they can continue to grow and continue to invest in growth, but also have a sufficient runway for them to be able to manage themselves through the current cycle. When you look across the rest of the portfolio, it really varies. But in general terms, we like to have all of our companies looking at a 12 to 18 month cash runway so that they can manage their growth over that period, and that's broadly what we've seen. And as I say, in the bulk of the NAV within the core, 12 months 90%, and 24 months 50%. So we think that's a good profile and a good solid runway for our bigger companies.
Great. And now looking at the PLC level, you recently completed the equity issue, which has bolstered your holding level liquidity. Can you provide some color on that, and also how do you expect to deploy that liquidity that you've got at your disposal now?
Yeah, of course. So our liquidity position from our trading statement is a significant improvement on this time last year, but certainly indeed even from September. As you said, we went out to the market, strengthened our liquidity around the Forward Partners deal by 55 million net, which has really given us that extra bit of runway to give us a bit more comfort as we bridge our cash flow through to realizations. Now, we, as I was talking about the way we like to manage our portfolio companies, I think it's important for us to take our own medicine here. And so we also look to about 12 to 18 months runway for ourselves. And we feel that with our existing LP requirements, with our cost of overheads, and a reasonable investment cadence, getting back to a more traditional investment cadence for us, then we think that the liquidity we have at the moment takes us out to that 18-month period with a degree of comfort. As we showed in the results, we've got 57 million of cash on the balance sheet, which is a stronger position than we were last year. We also have 63 million of EIS VCT liquidity that we can deploy into those strategies. And we have 60 million in our revolving credit facility that is undrawn. So when you look at that, that's all about 180 million of liquidity that we can deploy into the market. And so we think that that's a good place to be in an environment where prices are still low, and where we can then start to dip back into the market. So the second part of your question is, what are we going to do with that liquidity? And we will be announcing in the annual results, when we announce the full results in June, what our allocation policy will be. So we have been thinking, as you would imagine, for how we would deploy that capital, and we will be talking about that in a degree of detail when we bring out our full results in June. But suffice it to say, we will be ensuring that we have enough to manage our overheads, that we have enough to manage those ongoing LP commitments that we have, but also that we can plan to deploy back into the market, into the both primary market and to the secondary market, to start to pick up good deals as we go forward. And so we'll also be launching a number of third-party funds. We have to make sure we can stand our corner in those. So we will talk about our plans when we come out in June, but we do have a reasonably clear view about how we can use our existing liquidity, but also how we will use the liquidity that comes back in those realizations, as I said, that we are expecting to tick up over the next 12 months or so.
Great, thanks. And looking at the portfolio valuations, you've seen a rebound in portfolio valuations on a constant currency basis in the second half of 2024. Can you talk us through your thoughts on the valuations within your portfolio as they stand right now?
Yes, and I think I'd probably not quite so much say a rebound as a plateauing out. We've seen a couple of years now where public market multiples, lack of liquidity has driven down prices across the piece, across all private markets, and we've obviously been, we're not immune to that. But what we saw at the interims that we announced in November was that up until September we'd seen that plateauing, and really the second half of this year that has continued to be the case, and indeed maybe a small uplift in a couple of the most attractive assets. So I think that's where we see valuations. We do see a degree of stability. I think with some of the macro factors, particularly around interest rates, a greater degree of stability means that people are much clearer about the value of assets when they are on a go-forward basis, and that makes it much easier for us to value them. I think we also have to do this in the context of public markets. Really, in the tech space, particularly the SaaS space, have been on a 20-month bull run, and that's brought multiples down, not to a very low level necessarily, but to more of what we would term to be a kind of a long-term market level for multiples. So both in public market multiples, in our own assets, and also in the key fundamentals within the business, we see definitely a plateauing in valuations. I think the other thing to bear in mind is that what we've also announced is our companies, particularly in the core, our biggest companies, continue to grow, and they continue to improve margins. And so margins are up across the core, and sales for last year, revenue, which we were forecasting at about 50%, actually came in at around 60%. So these companies are now beginning to grow again. They're growing whilst they are increasing their margin at a modest rate. And whilst all of that's going on, our valuations are broadly remaining flat. And I think what that means is as these companies get bigger, as public market multiples continue to compress, and as our valuations stay flat, we have more confidence that they reflect the accurate value that they are being carried at today. We always try to carry our assets at the value that we think they can liquidate. Now, we understand that it's in a liquid market, but we always try to carry them at that value. When you look at our track record over the last 8 years since we've been a listed company, we've delivered over £500 million of cash back to the PLC, and the vast majority of that has been at or above the NAV that we're carrying it at. And I think that demonstrates the discipline that we have across our valuations piece. And we've just seen with the last two I mentioned earlier on, Endomag more recently, and the last couple of months, Perkbox, very tough environment, both exiting at above where we're carrying them. So I'm pretty confident it's a tough market. Valuations have come down, but I'm comfortable that the valuations that we're carrying now are an accurate value of where they would sit if there was liquidity as at the balance sheet date, 31st of March.
That's very helpful. Thank you, Martin. And good to see things moving from stable to positive, perhaps. But yeah, many thanks for joining me today, and look forward to the next results in June.
Thanks very much.